Hey everyone, and welcome back to Deep Dive Cuttlefish.
Yeah.
We're diving into some pretty choppy waters today, with all this talk about trade wars and tariffs. And a lot of you are probably wondering what it all means for your money.
Yeah, for sure. And you want to make sure you're making smart decisions. We're going to try to help you do that.
Absolutely. So today we're taking a deep dive into Mark Tilbury's latest video.
He's a really interesting guy.
Yeah, he's a serious investor,
Right.
obsessed with the stock market, and he doesn't hold back.
Mm,
His take on the current situation, let me tell you, it's a little unsettling.
a little bit, yeah.
Okay, maybe more than a little. But hey, knowledge is power, right? So let's break it down. Tilbury really focuses on how Trump's approach to trade, especially with all these tariffs, is a major factor in all this market uncertainty we've been seeing. He even uses this analogy of Trump being a deal maker, which I thought was interesting.
It's a good analogy. I mean, it kind of makes sense, right? Because it implies that these tariffs might not actually be the end goal, you
Uh-huh.
know? They're more like a tactic, almost like a bargaining chip to kind of pressure other countries into making concessions.
A high-stakes poker game, except the chips are our economy.
Yeah, exactly. The problem is those tactics can have some pretty serious consequences.
Yeah.
For everyone.
Like higher prices for pretty much everything.
Exactly.
I mean, think about it. If businesses are suddenly having to pay more for imported goods because of these tariffs, well, guess who ends up footing the bill?
Yeah, it's going to get passed right down to the consumer.
Right down to us.
Yeah, and it's not just about price hikes either. We could see major disruptions to global supply chains, and that means shortages. You know, certain products just might not be as readily available.
And that's just the tip of the iceberg, right?
Yeah. I mean, on a more global scale, these trade wars, they could really damage long-standing relationships between countries.
We could see whole new alliances forming, alliances that exclude the U.S., which could completely reshape the global economic landscape.
Right.
So it's not just about what we pay for a gallon of milk or a new car. This is about the stability of the whole system.
Exactly.
Global trade, global relationships, it's
Yep.
all interconnected. And this is where Tilbury brings up something I think is really important to consider. He talks about the Smoot-Hawley Tariff Act.
Oh, yeah, from 1930.
That's the one.
Yeah.
It was supposed to protect American businesses, but ended up making the Great Depression even worse.
Yeah, the whole thing backfired.
It's a pretty sobering thought.
It is. It really highlights how protectionist policies, while they sound good on paper, can have some seriously unintended consequences.
So what happened? I mean, why did it backfire so badly?
Well, basically, it started this whole cycle of retaliation. One country raises tariffs, then another one retaliates, and it just keeps escalating. Ultimately, everyone ends up getting hurt because global trade just grinds to a halt.
Okay, so that's what happened back then, but
Right.
is that what we're facing now? I mean, are we headed for another Great Depression?
Well, it's not that simple. The global economy is a lot different now than it was back in the 1930s. We're way more interconnected. But that lesson from Smoot-Hawley, I think it's still really relevant.
Okay, so we need to be cautious,
We do.
but not panic.
Right.
Just be aware of the risks. But how do we even begin to understand what's going to happen next with all this?
Well, Tilbury brings up a more recent example that I think offers some valuable insight. He talks about the whole tariff battle between the U.S. and Canada that started earlier this year in 2025. Remember that?
Yeah, it started with those U.S. tariffs on Canadian energy imports, right?
Right. And then Canada retaliated by putting tariffs on a bunch of American goods.
It felt like this tit-for-tat escalation.
It was, yeah. Each side trying to outmaneuver the other. And then things got really interesting when Ontario decided to impose that surcharge on electricity exports to the U.S.
Oh, yeah, that mainly impacted states like New York and Michigan, right?
Right.
It felt like a pretty symbolic move on Canada's part,
Yeah.
you know?
Yeah.
Like a way of saying, hey, we're not going to back down.
Absolutely. But Trump's response, it was anything but symbolic. He hit back by raising tariffs on Canadian steel and aluminum by a lot.
By a lot, like how much?
Like 50%. It was a huge escalation.
Wow. That seems like a pretty aggressive response to what you were saying was essentially just a symbolic gesture.
It was, and I think this whole back and forth, it reveals a lot about Trump's negotiating style. He's not afraid to play hardball, even if it means creating a ton of uncertainty in the markets.
So what does all this mean for us? How do we make sense of these trade wars and how they could impact our investments, the economy?
That's the million-dollar question, and it's exactly what we're going to unpack as we continue our deep dive. But one thing's for sure, we need to be aware of the potential risks, try to understand the motivations behind all these moves, and just stay informed so we can make the smartest decisions possible.
And speaking of potential risks, Tilbury brings up another point that's a bit unsettling. Trump's skepticism of NATO. I mean, he's been pushing allies to contribute more financially, and he's even hinted at the U.S. potentially stepping back from its commitments to the alliance.
Yeah, that's a whole other layer of complexity to this situation because NATO has been, one of the cornerstones of global security for decades now.
Right.
If NATO is weakened, it could embolden adversaries, countries like Russia and China. And that could easily increase the risk of regional conflicts.
Which could then spiral into global instability, which then impacts trade, energy markets, pretty much everything, right?
Exactly. And for investors, stability equals confidence. And when that stability is threatened, well, markets tend to react with, a lot of fear and uncertainty.
So we've got trade wars, potentially shaky NATO. It's a lot to process. But then Tilbury throws out this, almost unbelievable theory. What if Trump is actually intentionally trying to cause a market crash?
It sounds crazy.
It does. But Tilbury, he makes a pretty compelling argument that's a lot to take in. Intentionally causing a market crash. That just sounds so, reckless. What's the thinking behind that?
So Tilbury believes it could be a way for Trump to kind of force the Federal Reserve to lower interest rates. Trump's been very vocal about his dislike for high interest rates. He sees them as a kind of like a roadblock for economic growth.
Right. And of course, the higher those interest rates are, the more the U.S. government has to shell out to, service that massive national debt that we've got.
Exactly. So Tilbury's theory is, well, a market crash, as painful as it would be in the short term, it could really spook the Fed into slashing those interest rates. To kind of jumpstart the economy, get things moving again.
Okay, I see. So lower interest rates would lead to, more borrowing and spending, right?
Right.
Which could then hopefully lead to a faster recovery.
Right.
But is there any actual evidence to support this theory? Or is this just, speculation?
That's the tricky part. There's no, official memo from the White House or anything saying, hey, here's the plan. We're going to crash the market.
Right.
But it's still interesting to consider, what could happen if this actually played out, whether it's intentional or not. Because as Tilbury points out, a market crash, it doesn't have to be the end of the world. It could actually create some pretty unique opportunities.
Okay, so let's say, hypothetically, a crash does happen. What does Tilbury suggest we do to, not just survive it, but actually come out ahead?
His first piece of advice is pretty basic, but it's important. Build a strong financial foundation. Make sure you've got an emergency fund that can cover at least, say, 3 to 6 months of living expenses.
Right.
And minimize that high-interest debt.
Yeah, that makes sense. You don't want to be in a position where you're forced to sell investments at a loss just because your car breaks down or you have some unexpected medical bill.
Exactly. You got to have that buffer, that safety net. And once you've got that solid foundation in place, Tilbury suggests kind of shifting your mindset. Okay.
Instead of being afraid of a downturn, he says, try to view it as an opportunity.
Kind of like a giant sale. Everything's marked down.
Yeah, exactly. Like when your favorite store has a huge clearance event. But of course, that raises the question, how do you know when to buy and what to buy?
Right, because it does get a little risky.
Yeah, it does. You don't want to just buy anything that seems cheap. That's where discipline and research come in.
Mm-hmm.
Tilbury stresses that you should focus on, quality companies. Companies with solid fundamentals, the kind of companies you believe will be around for the long haul, the ones that can weather the storm and come out even stronger.
So it's about being strategic, not just reacting emotionally, right?
Yes, exactly. Don't panic buy.
Yeah.
Do your research. Invest in companies that you really believe in for the long run.
Makes sense. So, strong financial foundation, shift in mindset. What else does Tilbury recommend?
He's a big advocate for diversification. You know the old saying, don't put all your eggs in one basket?
All right. It applies to investing, too. You want to spread your investments across different asset classes. Stocks, bonds, real estate, maybe even consider precious metals or even cryptocurrencies if you're feeling adventurous.
So that way, if one part of your portfolio takes a hit, the other parts can kind of cushion the blow a little bit, right?
Precisely. It's all about managing risk. And another strategy he recommends is dollar cost averaging. Have you ever heard of that?
Yeah, I've heard of it. It's basically you invest a fixed amount of money, like every month or whatever, regardless of what the market's doing, right?
Exactly. It takes the emotion out of investing. You're not trying to time the market, guess the peaks and valleys. You're just consistently buying, which means you're getting more shares when prices are low and fewer when they're high.
Sounds like a pretty smart approach,
Yeah.
especially if you're worried about all this volatility we've been talking about. And speaking of ways to smooth things out, Tilbury also brings up dividend-paying stocks.
Oh, yes. Those are companies that basically share a portion of their profits with shareholders on a regular basis. So even if the stock price dips, you're still getting some passive income from those dividends. It's like a little bonus to help cushion the blow of a downturn.
Okay, so build a solid financial foundation. Shift to an opportunity mindset. Diversify your portfolio. Use dollar cost averaging. Consider dividend-paying stocks. It's a lot, but it feels, I don't know, empowering. Like we can actually do something instead of just sitting here and worrying.
Right. You have options. And it's important to remember that, we're not financial advisors. We're just discussing some ideas here. Everyone's financial situation is different, so do your research. Figure out your risk tolerance. And if you need to, talk to a financial professional.
Absolutely. This is about equipping you with information, not giving specific advice. But with all this talk of crashes and uncertainty, it's hard not to feel a little anxious. I mean, is there any reason to be optimistic?
Well, Tilbury thinks that even if a crash does happen, it might be a temporary dip before a massive rebound.
A rebound, really? What makes him think that? A rebound, huh? So he thinks a crash could actually be followed by like a huge upswing.
Yeah, that's his thinking. And it goes back to that whole theory about Trump intentionally triggering a crash, to get the Fed to lower interest rates.
Right.
Because if those rates do go down, well, it could create a really favorable environment for, for some serious economic growth.
Right. Lower interest rates, people start borrowing and spending more, and boom, the economy takes off again. I get it. But it still feels a bit like, I don't know, rolling the dice. So what kind of rebound are we talking about here? Like, would it be a quick recovery, a V shape,
Yeah.
or more of a gradual climb back up?
Well, that's the million-dollar question, isn't it? Trying to predict the market is, well, notoriously tricky. Even the so-called experts don't always get it right. I mean, there are just so many factors at play.
Right.
But Tilbury does point to some historical data, and that data suggests that markets, they do tend to bounce back, even after some pretty major crashes.
That's good to hear. At least there's a precedent for recovery. But I guess the big question is, how long will it take? And, how strong will that recovery actually be?
Yeah, and that's where things get really interesting. Because if Tilbury is right, and this is all part of some bigger play to kind of reset the economy, well, understanding that timeline, and the potential shape of that recovery, that could give investors a real edge.
So if someone buys into this theory, what should they be doing to prepare?
Well, first things first, it's important to remember that this is still just a theory, right? There's no guarantee that it's going to play out exactly this way. You never want to base your entire investment strategy on just one prediction.
Right. Don't put all your eggs in one basket, especially if that basket is based on speculation.
Yeah.
But let's say someone is, intrigued by this theory and they want to be prepared just in case. What would you recommend they do?
It really goes back to a lot of what we talked about in the last part, having a strong financial base, diversifying your portfolio, investing with a long-term perspective. But it also means staying informed, keeping an eye on those economic indicators, and being ready to adapt your strategy, as things unfold.
So it's not just about riding the wave, it's about being an active participant, making those smart decisions along the way.
Exactly. And if you're ever feeling lost or unsure about, how to navigate all this, don't be afraid to reach out to a financial advisor. They can help you create a personalized plan, something that fits your risk tolerance and your financial goals.
Right. Because in the end, it's all about making those informed decisions, not letting fear or emotion drive the bus. So as we wrap up our deep dive today, what's the one thing you want our listeners to take away from all this?
I'd say the most important thing is to remember that even with all this uncertainty swirling around us, there are still opportunities out there. And the people who stay informed, who keep a cool head and adapt to the changing landscape, well, they're the ones who often come out stronger on the other side.
I like that, a message of resilience and opportunity. Well, thanks for joining us on this deep dive into Mark Tilbury's market analysis. I hope you all found it valuable and insightful.
It was my pleasure.
And remember, folks, stay curious, stay informed, and stay invested. We'll see you next time on Deep Dive Cuttlefish.